Question number 1. Which of the following items does not appear in the cash flow statement? Cash flow statement is a statement that shows you the movements in cash inflows and cash outflows, actual cash payments. Deferred taxation means taxation that you have to pay later. You haven't paid it yet, so there was no cash. Since deferred taxation does not involve a cash movement, then deferred taxation will not appear in the cash flow statement. All of these involve cash, so they will show up in the cash flow statement. Which would you not find as a current liability in a statement of financial position, balance sheet? So which of the following is not a current liability? Trade creditors and payables are a current liability. Interest paid is not a liability anymore. Why? Because you have already paid it. You are no longer liable. It's already been paid. A company has completed a 1-for-5 stock split. That means every 1 share you have will be split into 5 shares. Following the stock split, the most likely impact on the company's debt to equity ratio will be no impact. Why? Because if before the split, let's assume before the split, your capital account was 1 million shares at $10, so your total capital was $10 million. So you made a split. These 1 million shares were split into 5. So after the split, your capital is going to be the same. You now have 5 million shares, but each share is now valued at $2. So your capital is $10 million. There is no change to equity. There is no change to debt. So your debt to equity ratio before and after the split is the same. Which of the following has taken into consideration the repayment of debentures? Debentures is bonds. So let's look at these quickly. So we've got enterprise cash flow. This is the cash flow which is available to debt and equity holders. So how much cash available to the whole company? Debt to equity holders. That's what we call the enterprise cash flow. Another name for it is the free cash flow to the firm. Now, if you remove minus payment to debt holders, what you will get, the remaining, you will get is the available cash to equity holders. So enterprise cash flow minus payments to debt holders gives you the cash available to equity holders, which we call the equity cash flow. So which of the following has taken into consideration the repayment of bonds? It's the equity cash flow. It has taken into consideration the payment to debt holders. So the answer is C. Enterprise value is the value of all debt and equity. The market value of all debt and equity of the company. So it's not the answer. Which of the following is not part of shareholders' funds or shareholders' equities. So which of the following is not part of the equity in the balance sheet? The answer is investment in associates, because it's part of the assets. It's a non-current asset. The rest of them, A, C, and D, are all part of the equity of the shareholders. A company has assets, 30 million, long-term debts of 10 million, and short-term debts or current liabilities, short-term liabilities of 5 million. The gross profit, operating profit, and profit after tax are 5, 4, and 2 million. So the gross profit is 5 million. The profit before interest and tax, or what we call the operating profit, 4 million. And the net profit is 2 million. What is the return on capital employed? The return on capital employed equals to the profit before interest and tax, the operating profit, over the capital employed. The profit before interest and tax is 4 million. And the capital employed is the assets plus the long-term debts, 40 million. So the return on capital employed is 10%. We have no need for short-term liabilities. We have no need for gross profit. We have no need for net profit. These are just useless information for this question. The share premium account could be used in which one of the following situations? A company does a capitalization issue, yes, or a bonus issue. Yes, capitalization is another name for bonus. Yeah. When a company makes a bonus issue, it takes the nominal value of these bonus shares from the share premium account and transfers them to the share capital account. So this is one of the situations where we can use the share premium account. Which of the following is the key difference between the current ratio and the quick ratio? Now, just to remind you, current ratio is the current assets over the current liabilities. What are the current assets? Current assets are cash plus receivables plus inventory. These are the current assets. So this is the current ratio. What's the quick ratio? Sometimes called the acid test ratio. It's the same thing. Minus is the current assets minus the inventory. So the quick ratio is current assets minus inventory over current liabilities. So the difference between the current ratio and the quick ratio is the inventory. Which of the following is not a heading in the cash flow statement? Dividends paid and proposed. Dividends paid is part of the cash flow statement. Dividends proposed means there is no cash dividend paid yet because it has only been proposed. It hasn't been paid yet. So even though Dividends paid, this first half of the question is correct. This word here, proposed, ruined it. Dividend proposed is not part of the cash flow statement. A company has an operating profit of 12 million. Operating profit of 12 million. Raw materials, which is part of inventory, increased by 4 million. So there has been an increase in inventory of 4 million. Receivables decreased by 2. There has been a decrease in receivables in the amount of 2 million. And the payables increased by 2. And there has been an increase in payables of 2 million. What is the operating cash flow? Now, starting from the 12, these 4, 2, and 2 million, what do you do? Do you add them or do you deduct them? That depends on their effect on cash. An increase in inventory, that means you bought more inventory, you lost cash. When inventory increases, that means you used cash. Your cash dropped, so you subtract. A decrease in receivables. Receivables are the amounts that your clients should pay you. If that amount drops, that means the amounts outstanding have dropped. That means your clients have paid you. That is an increase in cash. Increase in payables. Payables is the amount that you have to pay to creditors, to payables. If the amount of payables goes up, that means you haven't paid. You owe them more. Why do you owe them more? Because you haven't paid them. And because you haven't paid them, your cash has gone up. You didn't lose cash. So the operating cash flow is 12 minus 4, that's 8, plus 2, that's 10, plus 2, that's 12 million. So the answer is C.